income method. So now this is the last math that we have to do for all of the appraisal methods. This is going to be one of the shortest videos, which is nice, and there's not many questions on the exam here. So they're only going to give you 1 or 2 questions maximum on this method by itself. So the income method, what do we use that for? We use it for any properties that produces the income, right? It could be commercial, it could be rental revenue properties, right? So as an investor, what would I look for? Would I care how old is the building? Not really. What do I care? I care about the rate of return. I care about cash flow. I care about how much money would I put at the end of the day in my pocket as an investor, right? So that's what we're looking for. So that's why they say the life of the building is based on the economic factors. Remember we talked about different factors that affect the appraisals? It's about the economic factors. It's not about the physical factors of the building. We care about how much money would that put in our pocket at the end of the day, right? So that's what we're looking for. So that's why we don't care how old is the building. Because if the building is super old from 1800s, but it's one of those, I don't know, hotels that are the most popular with tourists, then guess what? It's perfect. Let it be old. I don't care how old, as long as I put money in my pocket. That's how you have to think about this. So appraisers, when they look at the commercial properties, what are they looking at? They're looking at, would they appraise current leases? Yes, it does. Why? Because it comes with the land. And if you have a lease for 20 years, comes with the property, maybe that will increase the value because you already have a tenant who pays you, right, on a monthly basis. Registered mortgages, why is it affecting appraisal? Because they are attached to the land too, right? It comes with the land, so they will look at it. Physical characteristics, right? So anything comes with the land itself, of course, you're going to look at this, but not the expected rents. So this is something that will not be appraiser, will not look at it because he doesn't care what will be a prediction. Something is in the future because nobody can estimate the rents in the future, right? So everything now, he'll look at it now, but everything for the future part that he cannot forecast something, right? So for that reason, he'll not add it to his appraisal. So we're interested in the yield. Yield is a percentage. If you haven't done the math yet, you'll do a lot of yield questions soon. But when they're referring to the yield, it's the rate of return. It's a percentage, is what we're looking for as an investors. So question 19, they said the investment method. So again, investment method is the same thing as an income method. Sometimes they'll call it one or the other name. It doesn't matter. An investment method of appraisal is generally used for what? Okay, not single family, not the airspace rights, latent value, that's the residual method, right? So property that produces the rental income, anything that produces you money. That's what we're looking for. So this is the formulas we're going to be using to find out, to do the math on the income method. And this is something you will be using in real life too. If you're going to get into the commercial real estate, now, by the way, for my real estate people, your license is good to buy and sell. And it doesn't matter if it's commercial or residential, you can do all of it, right? You can do both of them. It's not a problem. The only thing is after you pass the exam, they will ask you what type of applied course do you want to take? Do you want to take the commercial applied course or do you want to take the residential? Doesn't matter which one you take. At the end of the day, you still can practice both of them because that's your license good for everything. But the point is, if you're planning to get into the commercial, right, then they have a totally different ways of selling, calculating, and other things, right? So this is the formula that we'll be using to find out the property values. So in real life, what I'm trying to say, that we'll be using this. So the yield, which is a percentage, right? If on the exam they ask you, so what's the rate of return? They refer to the yield, right? So the formula will be the net operating income of the building. So it's not about personal stuff. It's all about the building. How much profit does it produce? And when they say NOI, it's a net operating income. There's a difference between the gross and the net. Gross, it includes everything, right? It's how much money you made, but then you minus all the expenses, and it shows you the true value of the income, right? We call it the net operating income. You take that income, you divide it by the sale price, and it tells you the rate of return. How much on a yearly basis you will get back from that investment, right? Your rate of return. Sale price, sometimes on the question they'll ask you, so how much should you pay for that investment? And if you were the commercial real estate agent, then you say, sure, let's find the net operating income of that property, and we'll divide it by the capitalization yield. Now, what's capitalization yield? It's an average yield. It's basically when you combine the yields from all the other buildings that produce revenues, right, in that area, then you will find out what's the capitalization, what's the average yield in the area, right? So net operating income. Lately, they start asking for this definition. So what is the net operating income, right? Does not consider depreciation, income tax, or debt services. So when they're referring to the net income, think of it as a clean income, right? I call it clean money. This is when you minus all of the depreciation, you minus the taxes, you minus the debt service, whatever that is you owe, you minus all of it. And whatever the clean comes up at the end, that becomes your net income, right? Net operating income. We call it the NOI. So when you see NOI, we refer to this. Capitalization rate, as I said, if you want to find out what's the average yield, the percentage, then you take, let's say the first, they'll give you the numbers, right? They'll give you, let's say 2 rates, you'll add them together, you'll divide them by 2, and that will give you that capitalization rate. So if I have a rate from building A is 4 and the rate from the building is 6, I'll add them together, that gives me 10, divided by 2, that gives me 5. So 5% will be capitalization rate. That's just an example, okay? Okay, just before we get anywhere else, how do you remember this formula? Just remember the NOI is always at the top. Always at the top, everything else goes at the bottom. It's a dirty formula, but the NOI is always at the top. Okay. Question 20. A property listed for sale has a net operating income of $15,763 per annum that is assumed to be virtual and constant. The market capitalization rate is 9.5% per annum. Per annum means per year. So if you haven't done the math yet, you will see a lot of math questions with per annum. Per annum means yearly, right? That's all you have to know. What is the maximum price that prudent investors should pay for this property? So they're asking for the price and they give you 2 numbers. So if you look at the question, if they give you 2 numbers, the dirty formula said that the NOI always has to be at the top, right? If you just remember that, whatever you have, keep the NOI at the top and then divide it by whatever is left in the question. So what you're going to do, you'll take that 15,763, you divide it by 9.5, right? Divided by 9.5%, and then it gives you the percentage, right? So here it says, don't forget to enter the 9.5 with the percentage button in there. I know a lot of people forget about this, but yes, when it's percentage, it's a percentage, right? Divided by 9.5%, and then equals, and that will give you the number, right? So pretty simple. As I said, I wish we had more questions like this. Okay, next one, question 21. A property recently sold for $800,000. Okay, so we have a sale price. The stabilized annual net operating income for the property is $88,000. So we have the NOI. Okay, and the yield of this property is. So if they give you two numbers, keep that NOI at the top. Okay, that's all you have to do. So you're gonna take that 88,000 divided by 800,000. Okay, whatever the second number is, and that gives you that 0.11. So that's 11%. The yield is. So sometimes they'll be not nice to you, and they're not going to tell you that, the NOI guy. So they're not going to tell you. They're not going to tell you how much is the NOI. So they're not going to tell you that net operating income in the question. And this is where you have to do one extra step to find the NOI before you can divide it by whatever that's given to you else in the question. Right? So the NOI could be missing. So how do you find this net operating income? This is the main formula to find the income, right? And I'm going to explain it to you through this example. And those two, you have two blank spots on your notes. I want you to fill them up as we go. So don't do it now. Let me explain you that first, and then you can fill them up. So the net operating income, we have on the exam, they like to trick you. Sometimes they like to talk about the gross potential rents, and sometimes they'll talk about gross realized revenue. So two different things. Potential and realized is two different type of revenues. So when they talk about gross potential, that means whatever you need for the whole year, all your expenses, all your vacancy in the bed, that's all the things that you will be minusing later, it all included in this gross potential. So for example, if I have an apartment that I can rent it out for $1,000 per month, potentially how much can I make per year? $10,000. Do you see that point, right? So the potential revenue, but 12,000, not 10. There's 12 months. So potential, I can make $12,000 per year, right? So that's common sense. So that's nice and easy. Thank you. And then I said, but look, I also had some vacancy. I had some bad debt. So that's, you're going to combine it as one thing for the exam purposes, right? Because it's basically when you couldn't rent it out for a couple of days or a couple of months here and there. So that comes out of your pocket. So that's something you're going to minus out of potential revenue. So in the exam, just know when you have to minus this vacancy and bad debt, right? So treat it as one thing though, right? So give you two numbers, sometimes you'll add them as one, okay? If I say vacancy of 10, bad debt is 1, then it's going to be 11%, right? So you will just add them together. But you will have to only minus it out of the potential revenue. And when you minus it out of potential revenue, that will take you to the gross realized revenue, right? So in this case, if I say that my vacancy and bad debt was $600 per year, so that means I lost $600, I could have rented for a couple of days here and there, that's out of my pocket. So then it will take me to the gross realized revenue. Realized revenue comes only after that vacancy and bad debt, right? So now I know that I made $11,400 for the whole year. But I'm not done yet. Now, if I want to know what's my net operating income, I still have to minus the expenses. Now, when it comes to expenses, what type of expense are we referring to? Is that the personal expenses? No, it has nothing to do with you. It only has to do with the property itself, right? So the taxes will be an expense, right? So it has to do with the property itself, property taxes, not personal taxes. That will be an expense for you. Okay, so in this case, I said expenses are $1,400. That's the property taxes, for example. You minus that, and it takes you to the net operating income. In this case, it's $10,000. That's how much you made out of all of those deductions, right? So net operating income. So if on the exam, they say gross potential revenue, then how many things you have to minus to get to the net operating income? How many things you have to minus to get to the NOI? And this is something you're going to fill up right now, right? So you're going to do, if it's gross potential, then you have to minus two things. You have to minus the vacancy and bad debt as one, and minus the expenses, and that takes you to the NOI, net operating income. We only do this when that NOI is missing in the question. So if it's not given to us like this, right, then you have to find it yourself. So if it's potential, you minus two things. But a lot of times in the exam, they'll say gross realized revenue, the gross realized income. Then what do? And they're still going to include that vacancy and bad debt in the question. That's what they're going to do. What is your job? Then you have to make sure that you minus only the expenses. So if it's gross realized, that means you already minus vacancy before. That means it's already deducted, and you only have to minus the expenses. And that will take you to the NOI. So the point of the slides is to know, make sure that they don't trick you. So if it's gross realized, you minus only one thing. If it's a gross potential, you minus two things, right, to get to the NOI. So what type of expenses? As I said, it's nothing to do with your personal expenses. It's not your personal taxes. It's not your personal life things, right? Not even the interest in the mortgage or mortgage payments. That's not an expense, okay? Not for this expense. So for the business, could be fixed expenses, something that has to be paid no matter what. And that's something to do with the government, always. Real property taxes, again, not income taxes, because that would be personal. Insurance policies that you have to pay, fire insurances, right? So all that stuff is a fixed expense. Then we have the variable expenses, like anything that happens, as you go. Management, utilities, you have to pay for your electricity, right? Maintenance and repairs. Now that's a cyclical repairs. Maintenance and repairs is cyclical. Now what is cyclical? Means it has to happen on a periodic basis, right? So it's like a cycling. It constantly happens, right? And you have to have some type of allowance set up for yourself on a yearly basis for that too. Cleaning, janitorial stuff, grounds and parking area maintenance. Sometimes you'll have to pay wages to maintain the property, garbage removal, decoration stuff, advertisement, replacement reserve. Just remember, there's no mortgage payments includes into your fixed expenses. If we talk about no mortgage payments and no personal income statements, right? So that has nothing to do with expenses. So kind of a question that comes up, sometimes it comes up with everybody's exam, sometimes it doesn't show up at all. So it's one of those odd questions. Talks about the replacement reserve. Now that applies only towards the rental building. So if you own the rental building and you have to know about the replacement reserve. So in UBC books, that's the only definition they give you, but then I'll give you a better one, okay? Provides for periodic replacement of building components that wear out more rapidly than the building itself. So basically, they said you have to have a reserve for your replacements, right? What usually wears out in the building? Carpets, right? What else? appliances, right? Like the stoves and the microwaves or whatever needs to be replaced on a kind of like on a common basis, right? You replace equipment with a relatively short life, such as stoves, refrigerators, washing machines, carpeting, right? So all of those things that has to be replaced at some point, and they're telling you that if you own one of those rental buildings, you should have the replacement reserve, right? Something that's set aside for you. So then they have this question, and this is one of those randomly selected questions. Which of the following describes a replacement reserve, right? So then they tell you it's a special fund to be used for the emergency only. No, it's not for the emergency because that's kind of used on a regular basis for any replacements that has to happen. So not that one. It is an annual sum that's set aside for the replacement, repairs, and renovations. Okay, so keep this one in mind. Okay, option 3, it's a schedule of anticipated cost for replacement of equipment, appliances, excluded major roof repairs and renovations. Could be this one. It is a stock of monthly supplies which would be periodically replaced. So that's definitely not this one. So it's always between option 2 and option 3 that students have a problem with, right? And say, so is that the annual sum that placed aside? So that means once a year they put a chunk of money towards that fund, right? Or is it the schedule of anticipated costs? Which one do you think is the right answer? Okay, it has to be the annual sum. So the better definition, and that's something that you should remember when it comes to replacement costs, should be the annual sum that's set aside for the replacement, repairs, and renovation, right? The annual sum is your keyword. Question 23. An appraisal and annual sum set aside for replacement, repairs, and renovation is best known as good, replacement reserve. So sometimes I'll give you the reverse question, nice and simple, just like this. Question 24. Which of the following items is deducted from the potential revenues? Remember we have a formula? We have gross potential, and then gross realized, and then we have the NOI, right? So what comes up from the potential revenue to arrive at the gross realized revenue when preparing an appraisal using the income method. So what do you have to minus from the potential to get to the gross realized? You have to minus the vacancy and that debt. Good. Question 25. Which one of the following items is deducted from the gross realized income to arrive to the net operating income when preparing the appraisal using the income method? So now what happens here? This is where you take, right, from the gross realized, you minus the expenses, and that takes you to the NOI. So a lot of times you'll have a question just like this without any math in it, and that's also good. Question 26. Which of the following is estimated using actual current rents paid on similar properties based on 100% occupancy, right? So this is where you haven't minus anything out of your revenue, right? It's based on what kind of revenue? A potential revenue. Potential revenue is where at this point you still have 100% revenue, right? And then you're going to minus things, minus. So when they're referring to the 100% occupancy, right, that's when they start with the potential revenue, and then they minus all the expenses and vacancies, and then that's when we get to net operating income. Okay, 27, are you determining the market value of the subject property using the capitalization process? The gross potential rent for the subject property is $430,000, right? So first you have to always pay attention what type of rent. If it's a potential, right, that's where you start from, right? So they say 430, that's a potential rent in here. And then it says that operating expenses will be $130,000, so that is an expense, will come up in there, right? And the long-term vacancy rate will be 4%. So far we have vacancy, we have the expenses. Do we have to have both of them? Yes, we do, because it's a potential revenue, right? In order for you to get to the NOI, you need to minus the vacancy first, and then you have to minus the expenses, and that will take you to that NOI, okay? They say the immediate repairs is $65,000 required on the property, and the appropriate capitalization rate will be 6%. The market value of the property is. Now, this question is very, it's harder than what will be on the exam, let's say that way, right? It has way more information, it has many steps in here, right? On the exam will be a bit simpler. It's not going to be as much things. They usually ask you just for 1 thing, 2, 5. But we do this on purpose for you to learn, and then when you go for the exam, your questions will be a bit easier than this, which is good. So if it's a potential rents, what do we have to do? We have to work in step number 1. What do we have to minus out of potentials? We have to minus the vacancy and bad debts, right? So what we're going to do right now, we're going to minus the vacancy, right? Step 1, you're going to take 430,000 minus 4%, which is the vacancy rate, right? And that gives you the 412,800. So far, that's how much it's a gross realized revenue here, right? So that's how much we come up with. Then we have to minus the expenses. The expenses here, 130,000, right? That's this, right? So minus the expenses, and this 282,800. That's your net operating income. Okay. So what you did first, you have to find NOI because it was not given to you. Now, what else are they looking for? They say the market value of the property. Market value means the sale price, right? That's what they're looking for. Market value of the property. So we have the NOI. Now we need the capitalization rate. Do we have that in the question? Yes, we do. So we know that the NOI is 282, and we know the capitalization rate is 6%. So what do? You minus it. So you divide it. So 282,800 NOI divided by 6%, which is capitalization rate, right? You do this minus this, and that shows you the sale price. So the sale price here will be 4,713,333. Now, you would think you would be done by now. And most of you guys will have the questions when you will be completely done, because they will not include this. They will not include this immediate repairs of 65,000. This is only my mortgage people might have on their exam. So I'll say it again. Most of you guys will not have this. You would find the income, you would divide it by the capitalization rate, and you would be done. Okay? But in this question, they also tell you that we have an immediate repairs of $65,000. And this is what you do at the end. So after you found the sale price, now you have to minus those repairs, right? So you take that sale price minus 65,000, and now it gives you the appropriate answer. But as I said on the exam, they don't go that far. So you don't have to worry about it too much. But just know that if they include it, usually mortgage people, then you make sure that you minus it right at the very end. Question 28. the potential buyer of the apartment block has asked an appraiser to do an appraisal of the apartment block in order to determine its market value. The following information has been made available to the appraiser. Estimated annual gross realized income is $44,200. So we have the gross realized income. Do you see how this gives the potential? Watch out. So that means we don't need the vacancy and bad debts. This says long-term vacancy allowance is 4%. So look at the formula. Do we need to use the vacancy still? If you had potential, then yes, you would use the vacancy. But because you already have gross realized, to give you that information to confuse you. No need for that. Estimated annual operating expenses, now we need that, is $70,850. In addition to this information, the appraiser has found two similar properties with the effective annual yield of 7.85 and 8.15%. Given the above information, the final estimate of value of the subject property rounded up to the nearest 1,000 of the date of valuation. So find the estimate of value of the subject property. They're looking, if you look at the answers, you see how it's all with money? They're looking for the sale price. What is the formula for the sale price? Is the NOI that always goes on the top divided by the capitalization rate, right? Cap rate, which is average yield. So usually on the exam, they'll give you one thing that will be missing, right? It could be the NOI or it could be the capitalization rate. In this question, both of them are missing, and that's on purpose, so we can teach you how to find both of them. But as I said on the exam, they're only going to ask you for one thing that is missing. So how do you find the NOI? So we have gross realized. And if it's gross realized, as I said, then we only have to minus the expenses, and that will take us to the NOI. And that's step number one. You take $44,200, which is your gross realized income. You minus only the expenses, $17,850, and that $26,350, that is your NOI. That's your net operating income. Okay, so we have that. Next one. What do you need for the formula? We need to also have the capitalization rate. What's cap rate? That's your average yield, average percentage. And in this case, they tell you that effective annual yields will be 7.85 and 8.15 for the similar properties. So how do you find the average yield? You add them together. And because there's two of them, you divide it by 2. If there was 3 of them, you would add them all 3 together. You would divide it by 3. Okay? So it depends how many properties. So if you have 2, then this is what you do. You add them. Now the rule is, when you add the yields one to another, you want to make sure that you don't add them as percentages. I know it sounds funny, but you have to add them together as numbers first. So if you do 7.85 plus 8.15, it will come up to 16. Then you divide it by 2, that's 16, and that will give you 8. And now you're going to take this 8% and use it as a percentage inside of the question, right? But when you add the yields together, add them as numbers. And then divide it by 2, and then whatever comes up, now you're going to be using that as your 8%. So now we have the NOI of $26,350. Now we have the capitalization rate of 8%. So now you're going to take that 26,350 divided by 8, and now you use percentage button, percent equals, and that will tell you the sale price. I know it sounds more complicated, but as I said on the exam, it's simpler. They only give you one thing to find if you have to find it. Last question. I promise no more. Okay, so this is not a very common question in the exam, just to make you feel better. You will have these questions in your homework. That's why we're teaching you, and that's why we're showing you them, just to get you ready for everything that might happen in the exam. So this question has a lot of steps in here. We'll work step at a time. If you need to pause me, please do. And if you need to watch Melanie's videos, go ahead and watch hers too. So you have been asked to appraise the apartment building using the income method approach, right? You have been given the following data relating to recently sold property A and B, and they are comparable to the subject property C, whose value is to be appraised. So basically, you say, look, you have a property A and the property B. Those have been sold, right? And now you're looking for the price for the property C. Now, if you look at that question in your notes, look how the answers are given to you. They're given to you within the range, right? So we'll get there. But just know what we're looking for is for the property C price at this point. Okay, so they say income method inside of the question. And if it's an income method question, that means you're going to be using your formula, right? Depends what they want. If they want the sale price, you'll put that NOI at the top, as usual, and then you can divide it by the yield. So that's what we're going to be using right now. So we need to find the income for every of those comparable property for each of them. So I need an income for the A, and I need the income for the B. So how do I find this NOI? You look and see what we have. If you have a potential revenue, remember how it works? If it's potential, how many things you have to minus in order for you to get to that NOI? 2 things, right? Look at the formula. You minus the vacancy and bad debts, and you minus the expenses, and that takes you to that NOI. So what we're going to do right now, we're going to take an A property first, and then we're going to work with property B. And we're going to find both of those NOIs for each of them. So if it's potential, you minus them both. So that's what we're going to do with the property A. We're going to take the income, $51,000. We minus the vacancy and bad debts, $4,080, minus $32,000, which is your expenses. You see that? And that takes you to $14,920. That is your NOI, right? So we've done the math. What else? So now we need to find the yield for this property. The price, so the formula goes NOI divided by the sale price gives you the yield. We have a price for the property A because it's already been sold. So what do? We found the income, the NOI. Now we're going to divide it by this sale price. That's what we're going to do right now, right? Income divided by the sale price. And that shows us the yield of the property A. Now look how long the number is. The rule is you want to make sure that you keep that number as long as it goes. Because if you cut it off, then nothing will work for you. Okay, so just know that you have to keep the full number. So okay, so I found the yield for property A. We're going to do the same thing for the property B now. Okay, let's do the same thing. Property B. First, we're going to find the NOI, right? So we're going to take the potential revenue minus the vacancy minus the expenses. So the income is $44,000 for the property B, minus $35,220 for the vacancy, minus $28,000 for the expenses, and the NOI came up to $12,480. Okay, so we found the NOI. What do we do now? We divide it by the sale price. the property B sale price was 211,000. Do you see that? So I'll do that right now. I'll take the income, right? I'll divide it by the sale price. NOI divided by the sale price gives me the yield of the property B. I'm going to keep that number as full as it goes, right? I'm not cutting that off. So now what do? I need to find the property C sale price. And if I'm looking for the sale price, what is the formula that comes with the sale price? It's going to be reversed. Sale price will be NOI divided by the yield. So I'm going to do the same thing for every single property. So first I have to find the income for my property C, okay? So subject property, my NOI, my income is 48,000 minus the vacancy, 3840, minus the expenses, 30,000. My income comes up as 14,160. So that's my NOI. That's income, okay? And the formula for the sale price, you take the income divided by the rates, right? So what we need to get the rates now. So what I'm going to do right now, I have my income for my subject property, right? I have the NOI, and then I have to take the rates. Now, if in the question, they give you only one answer, right? So in this question, if I show you, right, the answers look like this. They give you 1, 2, whatever, right? They give you the range in here. So if they give you only one answer, then you want to combine those yields from property A and B, divided by 2, and that will be your capitalization rate. But in this case, they want it for every single property. So I'm not going to add them together. What I'm going to do, I'm going to find it for each. So I'm going to take the income of the subject property, which is 14,160, and we just found it, okay? And what I'm going to do now, I'm going to divide it for every single rate, right? So I'm going to divide it by property A rate. So I take 14,160, divided by whatever the first rate of the property A is, okay? And it will come up to 222,080, right? So that's kind of what I got in there. And then I'll do the same thing for the property B. I'll take the same 14,160, which is the NOI from the property C, and I will divide it by the by the yield of the property B, okay, whatever that full number was, and it will give me that number, right? So this is kind of what you do if they give you the range between one to another number. If they give you one answer only, then they want you to combine those two yields, divide them by 2, and find that average number. But in this question, they just want you to have two separate ones. So that's it. We finished the income method. I gave you the worst question for the last. As I said, it's not a very common question in the exam, so you don't have to really worry about that one. This one is, out of all of the 3 appraisal chapters, this is the least, like this is the one that's not going to have many questions in the exam. So your major focus will be on your introduction. So the first appraisal video, the longest one, that's where the majority of the question will come from. Then it goes to the comparative and the cost method math. That has a little bit less questions, and this one only has 1 or 2 questions maximum. So it's not a big one on the exams when it comes to income method. But practice always helps. And that's it for the appraisals. And I'll see you in the next chapter.